If you have a deal in underwriting right now and you do not get your rates locked in by the end of Friday, you are rolling the dice on the most consequential FOMC meetings in the last 2 years. Warsh chairs his first meeting Monday morning, and that following Wednesday, that press conference can reprice the mortgage rates the same day. And if the May CPI report that we just got on Wednesday tells us anything, he's going to be hawkish. I'm Robert with Open Lane Funding, and here is your pre-FOMC report and breakdown. And I'm going to give you a 4-step action plan so that you can get started and get rolling before Monday. Wednesday's May CPI report, it was the critical data point before Monday's meeting. Here's what actually printed and why it matters for your deals. The headlines came in hot, and it came in up 4.2% year over year. That's the highest annual reading since April 2023. Month over month was actually up 0.5%, both in line with consensus. But the meaningful detail for rates was underneath that headline. The core CPI, which strips out the food and energy, came in at a positive 0.2% month over month versus the positive 0.3% that was actually expected. That's a sharp deceleration from the April's positive 0.4% year over year, and the year over year core held at 2.9%. So what drove the hot headline? And it's energy, right? Energy was up 3.9% month over month and 23.5% year over year. It was over 60% of the entire CPI increase. Gasoline alone was 7% month over month, and it's up 40.5% year over year. That's the Iran conflict, if I can speak today. My goodness. Dominating the print. And the Fed treats that as noise, right? The the number that the federal Fed Chair Warsh actually cares about is shelter inflation. And shelter came in a positive 0.3% month over month. And that actually is half of the April's expected pace. And the owner's equivalent rent is up 0.3%. Rent itself is up 0.4%. The core goods went negative 0.1%. Motor vehicle insurance went down 1.7%. Household furnishings went down 0.6%. And outright deflation is the big ticket. And these are the deflation and big ticket categories, right? Tariff pass through is still muted. Market reaction told you everything. The 2-year Treasury rallied 1 basis point to 4.11, and the 10-year held at 4.52. Stocks barely moved. The bond market said energy noise. Uh, we already knew about it, right? They didn't care, but the core deceleration still matters. For your pipeline today, that means that DSCR pricing is holding at 5.99 and 6.25 for qualified mortgages. Freddie Mac should still hold around 6.48, and rates are likely to drift slightly lower into Monday. The cool core print bought you a window, but it did not buy you a cut. So here's a broader picture, right? The macro environment is generally split. On the strong side, May's jobs at came in up at 172,000 against what they were targeting, which was right about 80,000. At least they thought 80,000 was going to be the increase. It actually went up to 172. April was revised up another 64,000. So that it's what 92,000 up in May, 64,000 up in April. So the 3-month payroll average is now sitting at 188,000. Jolt's opening came in at 7.62 million, and that's near a 2-year high. ISM manufacturing hit a 54%. That is the highest in 4 years. ISM services hit 54.5% for the 23rd consecutive expansion. Now on the weak side, Q1 GDP was revised down 6%. GDP now's Q2 estimate has dropped from 4.3% to 3% in two updates. The University of Michigan's consumer sentiment final May reading came in at 44.8%, another all-time record low since the survey began in 1952, and that is worse than 2008. ISM services prices hit 71.3%. That's the highest since August of 2022. Oil is back towards 95 per gallon or per barrel, and that is on the collapsed Iran ceasefire talks. The Fed's besieged book described as this as a K-shaped economy, and the upper income households are insensitive while the lower income cohorts are squeezing every single dollar. That's the exact same split we are seeing in the housing right now. The realtor.com May report just confirmed list prices fell 2.4% year over year. That is the steepest in the platform's 9-year history data. The 2.4% may not seem like a big number, but it is the steepest decline in the last 9 years that they've had this thing, right? But here is the critical nuance. Pending sales rose 4.3% year over year, and that is for the sixth consecutive months. So the market's growing, and the share of homes receiving price cuts actually fell. That's awesome. From 18.3% to 17.5%. Sellers are pre-calibrating to the market prices rather than listing high and cutting later. That's a healthier dynamic than the headline number suggests. House Canary confirmed median close prices were actually up 6% year over year in May, and the gap between closed and list reflects earlier contract vintages for closing. Adams Q1 mortgage or origination report shows purchase loans were at 581,000. Here's another report that hit the lowest quarterly figure in 12 years, and that's down 19% quarter over quarter. Sub 6.5% is the activation threshold for the buyer pool, and days on market are now flat year over year for the first time in this cycle. That's a meaningful stabilization milestone. Before the action plan, if you want the post FOMC reaction, the moment that it drops next Wednesday, hit subscribe right now. I'm publishing within hours of the press conference, and you do not want to learn about your rate move from the lender the next day. So here is your 4-step action plan before going into next week. Step 1. June 17th is the single most important day for your financing costs this quarter. Warsh's press conference will be explained word by word. Watch for two things. Does the easing basis language come out of the policy statement? And what does the dot plot show for 2026? Either one going hawkish means mortgage rates reprice at 25 to 50 basis points the same day. Step 2, if you have a deal in underwriting right now, call your lender today. Lock if you can. Do not cross the June 17th press conference with an unlocked rate on any deal that's close to qualifying, right? Get the cost of being wrong. I'm sorry, is real money. You could be losing money on your properties every single month because that interest rate could go up substantially, half a point high. Step 3, sellers are pricing to market from day one. Price cut share fell even as list prices fell. That means your negotiating window exists at the front end of the listing, not after 30 days. So make your offers now and make them data driven. Step 4, DSCR spread compression is real inside non-conforming markets. Confirm demand for DSCR exceeds supply right now. Qualified DSCR is holding at 5.9 to 6.25 today, and that's best case pricing is sitting at 5.8% to 6%, which is actually better than it was 2 weeks ago relative to the conventional investment pricing. That window may not stay open if the FOMC goes hawkish on June 17th, though. So if your lender's dragging your feet on a lock conversation today, call me. Numbers in the description. Monday, I'm going to go on a deep dive on Spokane and Coeur d'Alene data, the STR picture in North Idaho, the new construction pipeline, and the post FOMC rate reaction. I'm Robert with Open Lane Funding. See you guys Monday.